Everyone, today we're going to be talking about transaction accounting, or specifically double entry bookkeeping. This is a really effective way to keep track of a way that a business is transacting with third parties and how those transactions are then translated into the financial statements. If this is your first time here, please make sure to like and subscribe. And without further ado, we'll get started. So what we're going to do today is we're going to take a series of transactions, so a company raising capital through equity financing, debt financing, purchasing merchandise, selling goods. How does all of this get translated to the financial statements? And specifically, we'll be working with the balance sheet and income statements today. If this is all new to you, go definitely check out our Discord group. You may have seen a couple notifications already pop up in the lower right hand of my screen. But this is a free educational community with a premium group as well, but a lot of free educational content there. Definitely go check that out if you're completely new to financial accounting. You want to know what the income statement, balance sheet, and cash flow statements are. All of that is provided for free there. So with that, we'll jump in. So what we're going to do today is kind of what's on this tab. We're going to recreate this tab for this series of transactions over here on the next tab. So this is blank, and we'll kind of redo what we've done here. This is just to kind of show you what the end product will be of all the notes that we've done. And so to start, I'm going to show you, one, what happens when you finance a company with equity. So a stockholder pays some equity to receive stock in the company. What happens when we finance a company with debt? So a company goes to a bank to take a loan. How about when a company buys some inventory, sells that inventory as merchandise, investing in marketable securities like stocks and bonds, and investing in property, plant, and equipment. And we'll get two also bonus transactions here that we'll talk about at the end of the video, but I'll keep those hidden for now, and but you'll know what they are soon enough. So without further ado, let's just jump into modeling this out. So as I've noted, we're going to be focusing today on the balance sheet. And the balance sheet is one of three financial statements. So if you've read our other lessons, you know that the three primary financial statements are the balance sheet, the income statement, and the cash flow statement. And I'll do what's called Alt-HOI here. I'll also talk about some quick Excel shortcuts as well as I'm working here. So Alt-HOI allows you to auto-fit column width. And as we're working, we're going to create a balance sheet as well as an income statement. And perfect. We can do some quick formatting here. So Control-B, Control-U for bolding and underlining. Alt-HH allows you to change background. Alt-HFC allows you to change font color. So balance sheet has assets, it has liabilities, as well as equity. And what is the fundamental accounting equation? Where does the balance sheet get its name? From the equation that assets is equal to liabilities plus equity. The fundamental accounting equation is where every single transaction that we do today on the individual transactional level needs to obey this equation. We have a joke in investment banking and any high hour finance positions. What do you call a balance sheet that doesn't balance? An all-nighter. So when the balance sheet doesn't balance, something is wrong. So this here is the fundamental accounting equation. So holding control and then pasting. Why is this not coming over? All right, you know what? Let's type it in here. Fundamental accounting equation. Good enough. Auto-fit it. Add a column. So you can add a column with Alt-HIC. We'll do the same thing here. Alt-HH to change the background color. Alt-HFC, change the font color. And the income statement is going to have revenues, income that the business receives from customers, as well as expenses. And the important thing about the income statement is that revenues and expenses must match each other. This is the magic principle, that certain revenues are generated and expenses must specifically be linked to those revenues that were generated. And that's going to become more clear as we're working through the statements here. But with all that now being said, let's jump into our first transaction. So we're going to start a business from scratch. And when we start a business needs cash. So we're going to start a shoe business today, a business, either one that creates and sells shoes, or perhaps we're just a distributor, one that purchases shoes from a wholesaler, and then we sell those shoes ourselves. So let's say that we start a business. We start a shoe store business, and that business needs cash. That business needs cash if we're a distributor to buy shoes, to pay employees. And so we start a shoe store business with $500,000 in return for equity in the business. So we have a fundamental accounting equation. We'll just pop over here. So what happens to the accounts on the balance sheet? Well, first, the business received $500,000. So that means the cash account is going to go up $500,000. The business received $500,000 in cash from the individual incorporating it. So the balance sheet, we can already add that here. Cash, $500,000. But this equation needs to balance. Assets go up by $500,000, then either liabilities or equity or together, those accounts need to go up by a total of $500,000 as well. And so what happens on the balance sheet is that if somebody is giving cash to the business in return for stock or equity, equity will also go up $500,000. Now this is a bit oversimplified for you guys who already have some comfort with the balance sheet. It's not that we add $500,000 to an equity account. Instead, we add a total of $500,000 to both common stock and the additional paid in capital accounts. So common stock is really just the par value of a share. So shares have some nominal value, usually a penny. And when you buy common stock, the common stock account gets credited with a penny, but then every penny in excess of the par value of the stock goes into additional paid in capital. If that goes over your head, absolutely no worries. We're not going to talk about it again for the rest of this video, but that's just breaking it down for those who want to see explicitly how a offering of shares would be shown on a company's balance sheet. It would be distributed between common stock and additional paid in capital. Common stock would get each par value of the share, and additional paid in capital would be every cent in excess of the par value put into common stock. But to keep things very simple, we're just going to call this an equity account, and we're going to put $500,000 in. Boom. We're also going to do some quick formatting work here. Alt-HOH 4. That changes the row height to 4. We're going to Alt-HBM to add borders. Alt-C to add a color. Alt-S to change the style, and Alt-O to put the outline. I'm going to say total assets. Alt-HBP to add a border on top. Hold it. Alt-HOI to autofit column width. Total equity. Alt-HBP to add a border on top. Alt-HOI to autofit column width. And total liabilities. Alt-HBP, ooh, fat fingered. Alt-HBP, hold it, boom. And we'll sum, for now, just this one item. And so now we have total liabilities, which isn't anything yet, just sum an empty value here. But we'll do a little check. Is this balance sheet, does it obey the fundamental accounting equation? That's right here. Does this balance sheet obey this equation? Well, let's find out. So we can write a formula that says if total assets is equal to total equity plus total liabilities, then okay, it obeys the formula. If not true, that's not true, then we'll write total assets. Tell me the difference between total assets and total liabilities, that maybe I have a chance at finding out where I made a mistake. But as expected, we haven't made any mistakes yet, so we're all good. The balance sheet balances, everything's okay. Great. So you've just booked your first transaction for a business. The business went and did equity financing. Now let's say this $500,000 that the business received in equity financing isn't enough. We need another $500,000 to really get enough cash in the business to actually operate it, to buy the shoes, to pay the employees, to buy the retail space that we need. So what we do is we go to a bank for a $500,000 loan. So we go to the bank for the $500,000 loan. What now happens to the financial statements? Well, on the asset side, nothing changes. We're adding another $500,000 in cash, just as we did with equity financing. But this gets to the heart of the difference in financing between equity and debt. So financing with debt means that we're not adding anything with equity. We're adding here an account called long-term debt, or also notes payable. They mean the same thing. Here we're adding $500,000 liability. And so if you'll notice here, this equation also balances. Assets go up by 500,000, liabilities go up by 500,000. So both sides of this equation here both equal 500,000. So we already know that our balance sheet is going to balance. Let's drop this in here. Notes payable goes up 500,000. Oh, a little minus sign got caught in this formula. And cash also goes up another 500,000, so there's now $1 million in cash. Great. Now the business has $1 million in cash. We're a shoe store. We think we're just about financed enough that we need to start operating. So what's the next thing that we're going to do? If we're a shoe distributor, we're going to buy some inventory. We need to buy some shoes. We need to buy the inventory that we're going to actually sell to customers. And so we buy some inventory, and let's say we buy $200,000 worth of inventory. Inventory, which we plan to sell to customers at a profit. So we buy $200,000 worth of inventory, maybe we sell it for $400,000 so that we can make a profit of $200,000. But how does this purchasing of inventory affect the financial statements here? We're going to call this item 3, of course, because this is the third transaction that we're doing. Copy down our fundamental accounting equation. Great, now we're here. So we buy $200,000 worth of inventory. Let's say we buy it in cash. If we buy it in cash, then there's an outflow of cash of $200,000. And there's an inflow in the inventory account, also of $200,000. Alt HOI to autofit column width. Nothing happens to liabilities and nothing happens to equity. This whole transaction is booked on the asset side of the balance sheet, but one asset went down $200,000, another went up $200,000. So net, right, nothing happened on the asset side of the balance sheet and nothing happened on the liabilities and equity side of the balance sheet. So we do have a couple changes though, right? So inventory does go up by 200,000 and cash does go down by 200,000. So there's now $800,000 in cash, but net, nothing happened in terms of the balance sheet balancing. Notice we have total liabilities, 500,000, total equity, 500,000, and total assets, 1 million. So assets equals liabilities plus equity. We're still checking out okay. So now this next transaction is we're going to now sell this merchandise. And say we sell this merchandise that we just bought for 200,000, and we sell it for 400,000. So we're operating at a 50% gross margin, if you guys are comfortable with that language from the income statement. And so this transaction and number 6 are going to be the two most complicated transactions that we do. And this transaction is actually two separate transactions that are booked on the balance sheet. And we'll do the first one now. So we sell this merchandise for $400,000, and let's say we sell it for cash. So then we can start really simply. Cash goes up $400,000. Right? We sold some items to customers. They paid us cash, $400,000. Now, on the equity side of the balance sheet, we have an account called retained earnings. And retained earnings is an account that tracks all of the accumulated earnings that the business has received since inception. This can also be negative, in which case retained earnings is renamed accumulated deficit. But here, obviously, we're planning on making a profit. We sold shoes for $400,000 that we bought for $200,000. And so retained earnings will likely be positive at the end of this balance sheet event. So we're going to call it retained earnings. And for now, we're just going to book the revenue portion. And we're going to book this at $400,000. So what happens here is that we're now going to finally move over to the income statement. So that the income statement shows that we have $400,000 in revenues. We're going to have some expenses namely the $200,000 in inventories that we use to generate these revenues, but we're going to show that in the second piece of this transaction. So first we had cash go up $400,000, and we had retained earnings via revenue also go up $400,000. So now we're going to add retained earnings account to the balance sheet. We messed up the borders here, so just go Alt HBM O, add the borders back here. Retained earnings go up 400,000. And cash also goes up 400,000. So that was $1.2 million of cash sitting on the balance sheet. Notice this again balances. Now there's $1.4 million of assets, $500,000 of liabilities, $900,000 of equity, $1.4 million on both sides of the balance sheet. Great. But there's a second transaction that happens now because we've sold some inventory. So inventory went out the door, and we need to track what happens there. So in this second transaction, we sold this $200,000 worth of inventory that we purchased. We used up that asset. Inventory goes down $200,000, and an account also related to retained earnings, but called cost of goods sold, or COGS, which is the direct expense related to the sale of those goods. So the leather or the price required that we paid for those shoes, which was $200,000, is added to the cost of goods sold expense, which then on the income statement looks like this. We have called, we'll abbreviate it with COGS expense, $200,000. We have net income equal to the sum of revenues expenses. Put 4 on top. So inventory went down 200,000. Retained earnings also went down 200,000 because we required an expense, namely the using of the inventory asset. The revenue that we generated. So retained earnings is also going to go down 200,000. So that the retained earnings balance is going to be 200,000. Inventory went down 200,000 to 0, not to minus 200,000. Notice again, balance sheet balances. Great. And now we have some actual net income on the income statement. We have revenues and the expenses that generated those revenues. So again, we're operating here at a 50% gross margin, also technically a 50% net margin, but there would in reality be a set of other expenses required as well, such as any expenses paid to personnel to actually sell the shoes, etc., rent for the store, blah, blah, blah. So now let's do item 5, and this will be, again, a lot simpler than what we just did in item 4, and item 6 is going to pick up the pace again, and then we're going to close out with what is called adjustment entries. But investing in marketable securities, here, the purchase of stocks and bonds, specifically if this is short-term marketable securities, it'll be stocks and bonds at the business plans to hold for less than a year. Great. So if we're investing, we are using cash to buy those assets. So what's going to happen here is very similar to transaction number 3. Let's say we buy, how much cash do we have? We have $1.2 million in cash. Let's say we are comfortable investing $300,000 of cash. We think we will not need more than $900,000 of cash, the remaining balance, to operate the business, so we can safely put away $300,000. So if that's the case, then cash goes down $300,000. And an investment in marketable securities goes up $300,000. So notice, in essence, this is really similar to transaction number 3. One asset account went down and another one went up. So assets are net 0 and nothing happened to liabilities and equity. So here, cash goes down to $900,000. And inventory, marketable securities, which is going to be a new asset, is going to go up to $300,000. We're going to now replace this sum formula to get all of the assets Notice again the balance sheet balances. Now for our final official transaction, because there are going to be two what are called adjustment transactions. But for the final item that's listed here in this list, which is investment in property, plant, and equipment, or PPE. So property, plant, and equipment is an asset account that represents investment in things like factories, machinery, equipment, land, these tangible assets that the business needs to operate. And so say that we're tired of being a distributor, we're tired of buying shoes from other people and then selling those shoes. We actually want to manufacture those shoes ourselves. And so we're going to invest in building a factory in our backyard that can make shoes. And so specifically, that's a property, plant, and equipment investment, which is called an investment into PPE is called a capital expenditure. That's how it shows up on the cash flow statement. Don't worry, you don't need to remember capital expenditures for the rest of this lesson, but that is what they are called. That's how they show up on the cash flow statement. So investment, so we invest in the business to build a shoe factory in our backyard. Say this factory costs us $500,000 to make. So we'll book on the high level, we'll book a really simple transaction here, but the adjusting transaction is going to be the complicated piece of number 6. But high level, what happens, maybe you already know what happens with the cash. $500,000 of cash goes out the door. And PPE, I'll abbreviate that from property, plant, and equipment, goes up $500,000. This is a asset. It represents the factory that we have just constructed. So that's an asset on the balance sheet. So here, we're going to add one more asset, namely PPE, abbreviate here again, go up to $500,000, and we're going to remove $500,000 from cash because we spent that money to make the factory. And again, we balance. This is just like journal entry number 5, where cash went down some amount, marketable securities went up some amount, here cash goes down some amount, and PPE goes up some amount. So congrats, if you've made it this far, we've gone through each transaction here for this business. We saw how financing a company with equity, financing a company with debt, buying inventory, selling that inventory as goods to customers, investing in marketable securities, as well as investing in a factory, how all of these things translate to the financial statements. So you're starting to get an understanding of how transactions with third parties between the business now translate into the statements. However, we're going to do a bonus here, and we're going to talk about adjusting transactions or adjustment, backing out a bit here, adjustment journal entries. And what adjustment journal entries are for is that there were 2 transactions that we did here that are accruing some value. And I'll tell you what those 2 are. The first is number 2, where we got a loan. So a bank isn't just going to give a business $500,000 and let it run off. It's going to charge interest on that loan. And so say we're at the end of year 1 of the business. This business has now accrued some interest that it needs to pay on the loan. The second adjustment that we need to make is here in PPE. We've used some factory for a year, and we need to book an expense on the income statement that reflects using that factory to create the goods that we did. So we'll start with number 2. We'll start with interest, and then PPE may be a little bit more complicated, but here we'll start with interest, making an adjusting transaction for interest. Before we jump into the transaction itself, note that the loan we raised was $500,000, and say that the interest we pay on it, we got a 5.5% interest rate. That means an annual. We'll put a little note here. It means that the interest, gross or carrying value, is equal to the principal of the loan times the interest rate, $27,500. So at the end of year 1, we've accrued interest for $27,500, and say we haven't paid it in cash yet. So what we'll do first the transaction of accruing the interest and not paying it, and then we'll do a transaction where we actually pay the interest in cash. So what happens is we create a liabilities account called interest payable, to which we add $27,500. This is the interest that was accrued. It's a liability. It's a liability because it's an obligation that the business has. It's a sacrifice of economic value that hasn't been sacrificed yet. We haven't actually paid the cash, but we need to pay the cash. Then, on the equity side of the balance sheet, we have what's called an interest expense. And if the previous examples for retained earnings have made sense to you, then you'll notice that this affects retained earnings. So retained earnings go down $27,500. And we're going to go over to the income statement to book it. Another expense, we're going to have interest expense. Minus $27,500. We're going to sum it just like that. Boom. Now there's $172,500 in net earnings. So if you notice now in the accounting equation, liabilities went up 27,500, equity went down 27,500. So net, nothing's going to happen to the balance sheet. We created a new liability called interest payable. We added $27,500 to interest payable. I'm going to make these all currency here. I'm doing Control-Shift-4 with a special plugin I have called Mechanicus. It's like a power modeling tool that adds to the Excel functionality. But if you guys have Mechanicus or want to get Mechanicus, Control-Shift-4 lets you quickly designate these things as numbers from accounting, so currency. So what we're going to do, we're going to add interest payable here, as we did, and then we're going to also take this out as an expense from retained earnings. Retained earnings was $200,000. But now it's $200,000, that's $27,500. Boom. Now we're going to add this to the liability sum formula. Boom, and again, rebalance, as is expected. Okay, so we accrued that interest in interest payable. Say we're now going to actually pay that interest in cash. The first part of this transaction is simple. Cash goes down, $27,500. On the liability side, we've now gotten rid of a liability. We paid this liability. So the liability side of the transaction means that interest payable goes down $27,500. So we get rid of the interest payable account, and we remove $27,500 from cash payable. And again, we balance. Great. So we've just finished our first adjustment accounting transaction. It's exciting. Those are usually the things that students mess up on in accounting exams. And so make sure that when you're being asked questions in accounting and something that the business has now operated for a year, that you're checking in on all of the accounts that might require an adjusting entry. Now we're going to go for the final thing we're going to do today is entries for depreciation expense related to the PP&E purchased in number 6. So remember in number 6, we invested in a factory. And the next step for this adjusting journal entry, we're going to need to make a couple of assumptions about the factory. So in item 6, we bought a factory in our backyard for $500,000. So there's a couple of adjustments that we need to make here. And so first we need to make a couple of assumptions. So the first assumption is, what is the useful life of the factory? How many years do we think we're going to be able to use the factory? And let's say the answer to that is 5. The factory is going to be useful for 5 years before it's unusable, it's depreciated, torn down. You might have heard the word depreciated from when you purchase a car. As you drive that car, the car depreciates. If you drive the car enough, eventually it will break down, and so you're depreciating that vehicle while you are driving it. So we'll say the useful life of the factory is 5 years. We're also going to need to make an assumption for salvage value. This is at the end of the useful life, the factory is still worth something. The same way that at the end of your car's useful life, it's still worth something. It may not drive, but you can split it up for parts. And so here for the factory, let's say that the salvage value of the factory is $50,000, right? The factory may be completely unusable, but we can still sell off the construction materials that we use to build it on some secondary market for guys that require construction materials. So we use that factory, and so by using that factory in this next year, there's actually an expense that needs to be booked on the income statement because the factory helped us make these $400,000 in revenues. So anything that helped us make these $400,000 in revenues needs to be booked as an expense so that we get a proper visualization of what the earnings of the company was. So we're going to put something here called depreciation expense. And we're going to calculate that now below with the assumptions that we've made. So these assumptions that we've made on useful life and salvage value are going to help us get to depreciation expense. And how do we calculate depreciation expense? The formula for that is the purchase price of the asset less the salvage value of the asset divided by the useful life of the asset. This is specifically the straight line depreciation method. We're not going to get into the different types of depreciation calculation methods, but straight line is the most simple, and that's what we'll use here. So if we're going to now calculate the depreciation expense value, remember we bought the factory for $500,000, the purchase price of the asset. The salvage value is $50,000. The useful life is 5 years, $90,000. So we have a $90,000 annual depreciation expense. So what happens now in the adjusting journal entry to make this all fit on the balance sheet? We're going to create what's called a contra asset account for accumulated depreciation. So when you look at a balance sheet and you see PPE, you're not looking at the gross value of PPE, you're looking at PPE net. And PPE net is the gross value of property, plant, and equipment plus the contra asset account that is accumulated depreciation. And so we're going to build that out explicitly here. And so what happens after this first year is that accumulated depreciation, we're going to put a little XA here for contra asset account, and contra is spelled C-O-N-T-R-A. Contra asset account goes up $90,000. But it's an inverse account to an asset, so it's actually an asset account going down $90,000. It is PPE net going down $90,000. But we call a contra asset account. We still, by convention, give it a positive value. I guess there's some leeway here if you choose to give it a negative or positive value. But I think there is a correct answer in the accounting textbooks. But as long as you know that accumulated depreciation net reduces assets, that's the important part here. So accumulated depreciation reduces assets, and then similarly, as the adjusting journal entry that we did above, there's an effect to retained earnings through depreciation expense, as we alluded to by creating that line item on the income statement. Retained earnings goes down by $90,000. So we have a depreciation expense of $90,000. So that net income is now $82,500. And so retained earnings here goes down $90,000. That's shown on the previous transaction. And then we also have this contra asset account for PPE that when we net PPE, it goes down by $90,000. So we'll rename this net. We're going to put an equal sign here because this is a formula. And boom, look at that, we balance. So we made two adjusting journal entries, one for interest and one for depreciation. And our balance sheet still balances as it should. No all-nighters tonight. That's great. So you guys have effectively just gone through all 6 of these transactions: financing a business, buying inventory, selling inventory, investing in marketable securities, investing in a factory, as well as making adjusting journal entries for what happens after a year of operating in the business. And so this very much is the manner in which we translate transactions into the financial statements. And getting used to the way that we book transactions and the way that transactions affect the financial statements is very important to evaluating a business and understanding its financial statements. So this is a great first step on your journey in fundamentals investing. I hope this was super helpful to all of you. This Excel file is available to the premium members in our Discord. So you can upgrade to the premium role in Discord just by joining the Discord, and there's a little upgrade here channel. But this video, of course, is public, and we do go over lesson reviews and all of that in the premium channel of our Discord, but there's also a ton of information that is free in the Discord. So again, I hope this was super helpful. Please like and subscribe to see more of our videos. And with that, have a great night.